Silver's story didn't end at $50. It didn't end at $59. It doesn't even end at $100. Because the real, brutal truth is this. We haven't actually priced in the thing that will decide where silver lives for the next 30 years. Not banking rules. Not central banks. Not memes. Green energy. That's why this video is called Silver's Hidden Stage 4. Why green energy demand will make the tech boom look like a warm-up. By the end, you'll see why the famous 4-stage pattern in silver isn't just about paper versus physical. It quietly has a fifth player no one accounted for. How the tech boom only sampled silver's potential, while green energy is about to put it on a forced, permanent diet of demand. Why the real stage 4 isn't just a paper market break, it's a long, grinding repricing under structural scarcity. And how to think about silver in a world where solar, EVs, grids, and batteries quietly become your biggest competitors for ounces. This is not personal financial advice. It's a map of where demand is heading, not just where the chart has been. Let's start with the pattern everyone thinks they understand. 1. The classic 4-stage pattern and the part everyone missed. You've heard this before. Stage 1. Establishment. A metal becomes money. Governments back currency with it. Coins are minted. Everyone trusts the system. For silver, that was silver in everyday coins. Silver backing paper notes. The era where you could walk into a bank with $1 and walk out with metal. Stage 2. Manipulation. Paper claims are created on top of physical metal. 1 ounce becomes 10 claims, then 50, then 100. Paper is profitable. Physical is old-fashioned. The price looks stable because supply looks infinite on screens. Stage 3. The squeeze. People start asking for actual delivery. Vaults drain. Banks quietly pull products. Certain regions say no more retail silver. Spot starts behaving strange. Premiums rise. Backwardation appears. Physical says, this price is a lie. Stage 4. The break. The paper structure fails. Trading halts. Delivery failures. Contracts cash settled against the buyer's will. Physical sets its own price, and paper either chases or freezes. That's the pattern everyone talks about. But there is a hidden stage 4 that rarely gets mentioned because it doesn't play out in a week, or a month, or even a year. It plays out in decades and has nothing to do with COMEX or LBMA. It's called structural demand repricing. And its face isn't a hedge fund. It's a solar panel. 2. Stage 4, rewritten when green energy becomes the whale. In the old world, silver's main tug of war was investors versus industry. Industry used it, but could often step back when price exploded. Investors stampeded in during panics, then wandered off again. The system assumed, if price really gets out of hand, industry will back off, investors will cool down, and will drift back toward normal. That assumption dies in the green era, because the new biggest players in silver aren't momentum traders or coin stackers. They are solar manufacturers under government mandates and contracts, EV makers tied to multi-decade electrification plans, grid builders trying to harden and expand power networks, data centers and battery projects feeding AI, cloud, and storage, national energy planners trying to appease voters while keeping lights on. They don't come to the market asking, is silver at a nice discount today? They come asking, how do we secure enough supply to hit our deployment targets? Whether the price is nice or not, that's stage 4. When policy-driven demand meets physics-limited supply. And it's why the tech boom, the dot-com era, the smartphone explosion, the early data center wave will look small compared to what's coming. Because tech was a luxury upgrade. Green energy is being treated like infrastructure, survival. 3. Silver and tech versus silver and green energy. Why the old playbook fails. Let's compare 2 eras. Era 1, the tech boom. In the tech era, silver went into circuits, contacts, switches, solder. Important, yes, but spread out. If prices rose, manufacturers could thrift some silver content, design around it a bit, absorb small cost changes in high-margin devices. Your smartphone has tiny fractions of an ounce spread across components. The silver cost per unit is small compared to retail price. If silver doubled, it hurt, but it didn't topple the whole business model. Result: Tech demand for silver was big, but flexible. It could bend with price without collapsing. Era 2, the green energy wave. Now compare that to solar plus electrification. Utility-scale solar farms ordering millions of panels at a time. Governments counting gigawatts of capacity, not phone units. Long-term contracts based on hitting climate, energy, and grid stability targets. Silver here is not just a nice-to-have, it's in the core operating layer of the panel, the conductive pathways that move electrons. You don't just rip that out and swap it easily. And you have entire countries saying, we will build X gigawatts by 2030. Corporations pledging net zero with timelines. Utility companies building their entire future capacity around renewables. Now imagine telling them, sorry, silver doubled. Let's cancel the transition. They won't. They can't, not without political chaos, legal issues, and energy crises. So what do? They do what every forced buyer does in a tight market. They pay, they hedge, they pre-contract supply, they stockpile. That's where stage 4 stops being about traders get blown up and starts being industrial giants and governments become accidental speculators in silver supply. This is the part almost no one has priced in. 4. Why green energy demand doesn't care about your chart. Think like a solar CEO for a moment. You don't look at silver like a retail trader. You look at project timelines, power delivery contracts, government incentives and penalties, cost per watt over 10-20 years. And you ask one question, can I secure the materials I need to build the capacity I've already promised at a cost that keeps this project alive? Silver is a small line item on a massive project spreadsheet. If silver doubles, it hurts, but your project doesn't instantly die. You can justify the extra cost by passing along a tiny increase in electricity prices or accepting slightly lower margins. If silver triples, you grumble more. You go hunting for efficiencies. But if the choice is pay more for silver versus don't complete the solar farm, you still pay. From silver's point of view, that is terrifyingly bullish because it means price sensitivity is lower than people think. Demand is sticky, even at high prices. The kill switch, where industry walks away, is much further out than traders assume. Now add EVs. Each electric vehicle uses more silver than a combustion engine car in circuitry and electronics. Governments are pushing hard. Bans on ICE sales, EV quotas, tax incentives. Does an automaker like the idea of more expensive silver? No. But if regulators say, no EV rollout, no compliance, no access to markets, they'll pay. Add the grid. New transmission, smarter substations, upgraded hardware, all of it quietly pulls on silver. Add storage. Advanced batteries and power electronics. Add data centers. Power conditioning systems, cooling controls, backup infrastructure, all with silver in the background. Everywhere you look in green energy, silver is hiding in the wiring. And all of those sectors have the same message. We don't care about your short-term chart. We care if the material is available when we need it. That's stage 4. When time horizons stretch far beyond trading windows, and silver stops behaving like a trader's toy and starts acting like infrastructure feedstock. 5. The real endgame. Long, grinding scarcity. People imagine stage 4 as one epic spike. One day where silver hits some insane number, then everything resets. But that's not how structural demand works. The hidden stage 4 looks more like this. Chronic deficits become normal. Year after year, demand quietly outruns supply. Green energy demand grows. New mines are slow, expensive, and face regulation. Recycling helps, but doesn't plug the gap. Analysts call it a market in persistent deficit. Inventories drain in slow motion. At first, above-ground stockpiles cushion the gap. Vaults and strategic reserves are tapped. Scrap flows increase a bit when price rises. Then, the easy stockpiles dry up. What's left belongs to strong hands, long-term holders, strategic buyers, governments. Price finds a new floor, not a new spike. Instead of silver blasting to a crazy high and collapsing, you get a series of step-ups. Each cycle finds a higher floor than the last. Cheap silver becomes a memory. The old world where $15, $20 was normal, gone. The $50, $60 band becomes the new baseline, not the blow-off. Policy and industry lock the door behind you. Once big projects are costed at higher silver prices, governments normalize it, utilities bake it into rates. Manufacturers adjust contracts. You're not going back to cheap silver because the entire structure has recentered around expensive input costs. That's stage 4 as green energy writes it. Not one explosion, but a slow, relentless repricing as a finite metal becomes non-optional for the world's energy system. 6. What this means for you if you're not a solar CEO. So where does that leave a normal person? You can't move markets. You can't set policy. You can't rewrite grid plans. But you can decide how you want to be positioned in a world where silver is both monetary hedge and energy metal. The gold-silver ratio has already started to snap in silver's favor. Green energy has quietly signed silver up for a multi-decade career. Here's a calm way to think about it. A. Stop thinking in spikes, start thinking in regimes. Instead of asking, will silver spike to X next month? Ask, what does my life look like if silver never sees the old cheap range again? In a world where sub $20 silver is gone, $50, $80 is normal, $100 plus is visited when stress hits, do you want 0% exposure to that metal or some share of your wealth sitting in the thing being repriced? That's not a trading question. It's a regime question. B. Decide your slice in a green world. Pick a framework. For example, 5-15% of net worth in precious metals. Within that, a split between gold as the monetary anchor, silver as the high-torque green plus monetary hybrid. The exact numbers are your call, but write them down, because in an age of structural scarcity, no decision is neutral. 0% is a bet. Some deliberate slice is a plan.